Something unimaginable in the past happened after the collapse of Lehman Brothers. In response to output and job losses, most of the emerging market economies eased their fiscal policies. For example, in G20, each emerging market economy announced various fiscal stimulus measures as of the end of first half of 2009. However, for example, 6 of these emerging market economies had similar output losses and job losses in the past, in the 1990s or at the beginning of 2000. But 2009 was different. In the past, they had to tighten fiscal and monetary policies, but in late 2008 to the end of 2009, they implemented counter-cyclical policies. The main reason was that in the now episode, that's 2009, 2008, they had room for maneuver, but not in the then episodes in the past. Their public debt and budget deficit were much lower in 2009 compared to the past crisis episodes. So the first positive outcome of sound budgetary and fiscal policies is that you can take counter-cyclical measures when needed. So you graduate to counter-cyclicality league. Sound budget and fiscal policies also provide more policy space for automatic stabilizers like unemployment benefits, and also give the room for maneuver for allocating resources to social expenditures. Sound budgetary and fiscal policies remove fiscal dominance and set the stage for a sound monetary policy as well. Lax fiscal policies lead to build-up of public debt and they set the stage for fiscal dominance. High public debt, if widely conceived as unsustainable, lead to increased risk perception, real interest rates, loss of confidence, and increased demand for foreign currency denominated assets in most of the emerging market economies. Under these conditions, implementing monetary policy becomes rather difficult. Suppose that the central bank increases its policy rate to curb inflationary pressures in such a country. If such a move of the central bank increases concerns about debt sustainability due to a possible rise in public sector borrowing rates, rather than decreasing inflation expectations, it could backfire. It could backfire in the sense that confidence could decrease, risk perception could increase, currency could depreciate. Under such circumstances, inflation could further rise. This is one of the main reasons behind fiscal austerity proposals. Note that the pros and cons of fiscal austerity or fiscal accommodation are not independent from debt sustainability concerns and associated risk perceptions. In a country in which real interest rate is very low, there is no risk and if there is no risk perception arising from public debt, fiscal austerity could, in the short run, be unnecessary. However, in a country with high risk perception arising from public debt sustainability issues, fiscal austerity could be supported for real economic activity by increasing confidence in the short run. Sound budgetary and fiscal policies is also essential for a sound and pro-growth financial sector. Financing need of government should not crowd out private sector. High risk premium and high real interest rates could jeopardize financial stability as well. However, this relationship is not one way. Problems in the financial sector could be transferred to and become the problem of the public sector over the night. So, soundness of fiscal policy cannot be analyzed in isolation to the soundness of the financial sector. One example to this is 2001 crisis in Turkey. And due to the collapse of the banking sector, due to the banking strengthening program of the banking sector, public debt to GDP ratio jumped to 105% from 70%. So, and immediately it led to debt sustainability concerns, and real interest rates jumped to 20%, 25%. So in that environment, that's why the Central Bank of Turkey at that time introduced implicit inflation targeting, like this morning our Moroccan friend was talking about, and only switched to formal inflation targeting at the beginning of 2006. So from a macroeconomic policy perspective, as far as I can see, these are the importance of sound budgetary and fiscal policies. I should stop here. Thank you.